Let's take a deep breath and let's try to relax. Been a rough day today. It was a not totally unexpected, I'd say, but I'm not going to say it's an overreaction either, but it was a lot more red and a lot more devastating than I expected to see immediately. But let's admit, this has been a difficult year. If you've been having problems trading, if you've been having problems with your options strategies, so have we. But that's why we're here every Friday and during the week for coaching sessions and more to help you navigate these markets. The last 6 months, we've seen a lot of negative movement. We all know that. We've all been here. But in addition to that, we've also seen some fake outs where we hope that, hey, maybe things are turning around. We're seeing some stability for a couple weeks, and then all of a sudden we're back down to a new lower low. And then we have a surprising run here, 3 months in. Pretty spectacular, pretty decent for a bullish market once SPY jumped above the 20-day moving average. And then we went back to a new lower low and we tried to recover and we're almost right back down. Not quite, still another 10, 15 points to go maybe. But the news today, the inflation news today and everything else took a lot of wind out of the sails, but it was also coming up tomorrow and sort of preview of what was expecting. We saw the market pull back from 410 down to about the 402 level, and then the big decline today, another 3 or 4% or so at different times during the day, down to 390, but coming back up slightly. Halfway through the year, 6 months of a slight bit of a roller coaster, let's be honest. But I'm just going to say, personally, and I haven't talked to Ernie about this, so this is more Mike's opinion of going forward, not Ernie's. I haven't had a discussion with this, but I expect, I should say, continued volatility, continued ups and downs, continued roller coaster for the next few months until some things start to ebb. There's a lot of talk out there right now. We're seeing some people say that this inflation news is going to cause the 0.75 interest hikes back on the table. Some are saying that the markets have already priced in 3 continuous 0.5 rate hikes, but a 0.75 might cause a lot more uncertainty and a lot more unease. Some say the markets have another 25% or so of decline possible in them before it reaches the bottom. Some say the S&P 500 and the markets will finish strong at the end of the year. Personally, I am expecting and trading for more of the same of what we've seen in the last 6 months. Now let's review briefly a few slides from our discussion on May 27th. Since the start of the year, what was the community focus here at Power Options through the webinars, through coaching sessions, emails, and much, much more? Well, earlier in the year, we had discussion on bear put debit spreads. We talked about how Ernie started buying puts, and then when he saw a profit on those puts, this was in January, he would roll down those puts for profit and convert to a bear put debit spread. We were talking about out of the money bear calls 30 to 60 days out, or at the money, I should say, bear put debit spreads for the uncertainty in the market. A similar structure, but we talked about calendar spreads, calendar put spreads to be specific, buying puts maybe 4 or 5 months out in time, maybe to May, maybe to June, around the middle of January, and then selling nearer term puts against that. But this was the bearish view. We were buying a deeper in the money put, maybe 2 or 3 strikes in the money, and selling mostly out of the money, 1 or 2 strikes out of the money below the current stock price in those cases to profit in the bearish decline. In the bullish terms, hopefully we had generated enough income to counter the loss we'd start to see on those longer term puts, or we could make adjustments. And a lot of the focus was on management of existing positions, rolling to lower strikes on covered calls or naked put positions, increasing the probability or lowering the delta, going deeper in the money with covered calls perhaps, or the naked puts. Adding put options to a covered call to create a collar, or further out naked cash secured puts to create sort of that maybe bear put debit spread, or a hedge as far as a calendar put spread for the uncertain markets we were seeing. And then other ideas that we had for entering the unknown and uncertain markets. Talked about setting up 3 to 4 month strangles on broad market ETFs, SPY or QQ. This is not a standalone position where I would just open a strangle and just sit there. We would roll or adjust the positions as the market moved, take profits on one side and rebracket, similar to what we do in a bullish or bearish collar position. And I don't mean a short collar. I mean, for those that were on level 2 trading, that's a little bit later, but I'll talk about that in a moment. Got ahead of myself. We discussed buying shares of volatility ETFs, VXX, UVXY, maybe calls on the VIX when the VIX was lower in the $25, $28 range, or other market hedges because gold and silver was not cutting it, but gold and silver started to see more of a reaction recently. The dollar was strong, so gold and silver weren't being the traditional market hedge that we'd want to see. That's where shares of the volatility ETFs or maybe calls on VIX came in, but the calls on VIX got pretty expensive, and they're pretty expensive right now as VIX almost crested 30 again today with the news on inflation. The new plays we looked at were buying calls on oil and gas, what has been going up, what has been moving up, and purchasing some puts on retail ETFs, on the ETFs themselves. Not the individual stocks because of the increased implied volatility. There was very expensive to buy puts on those, but you could get some good action on just the retail ETFs, buying put options on those because the retail was kind of spotty there for a while. And then again, married puts following the rules in the blueprint radioactive trading to avoid the wild swings in market volatility. We're going to take a look at that in a little bit. Consideration of married puts with an extra put income method number 12, one of the 12, technically 13 income methods discussed in the blueprint against the married put, and standard collars to keep protected the core holdings in uncertain markets. And those that were only on level 2 trading that didn't want to buy puts because they were too inflated during those downturns, you could actually create a bearish collar structure with being long the stock, selling an at or just slightly out of the money call and buying a higher strike put, a debit collar in that case, but it would give you still a 2 to 3% return as the stock fell, with only taking on a 3.5%, maybe 4% risk if the market went the opposite and started to go up in those 1 or 2 time frames in the last 6 months that we saw. Taking a look, this is the adjusted one that we had in the May 27th. We showed SPY and what had happened to discuss kind of what we did, what I did. I don't want to say what Ernie did, but there's some discussion on what Ernie did in here as well. And what we talked about during the webinars. So in the beginning of January, we're talking about managing existing positions, protecting positions, managing married puts, the bear put credit spread concepts, the calendar put spreads, and discussion on uncertain markets wavering up and down, taking a look at buying strangles, SPY, QQQ, IWM, broad market ETFs. You could do the index as well. It's just cheaper cost-wise to buy them on the ETFs. Well, saw the SPY go above the 20-day moving average. It got froggy, opened 7 bull puts in 2 different 2-week cycles, essentially, during the February period. But 3 of those 7 had to be managed with the pendulum adjustment, one of the 8 ways we suggest to manage bull put credit spreads. Were managed to a profit or a very small loss on the position using the pendulum adjustment, and that worked out okay. But it was almost a fake out, wasn't it? We just went right back down to the lower lows. And we went back to managing the married puts, maybe those bearish collars, bear put credit spread concepts. And then we had this rise in March. The SPY jumped above its 20-day moving average. We're talking about new standard bullish collar positions with protection because did we trust it? Adjusting the strangle positions that were seeing a profit on the downside, but now starting to move back up, rebracketing the collars like we might rebracket. The strangles and the collars, and the married put positions that were open. We started to turn again, going into April, doing income methods near that peak on the married put positions, selling calls, generating income, lowering the risk, rebracketing collars, or close the collars in that case, depending on where we stood. And personally, I missed out on the bear puts because I saw that small move upwards and thought, okay, we're coming back up, but it was a big fake out. And for the rest of March, we went down. Or May, folks. The rest of May, we went down. That's when we discussed the earnings plays. We were in the thick of earnings season. Still concerns on supply chain. Still concerns on Ukraine and the war over there in Europe. Still concerns on inflation. But seeing how the earnings were coming out for oil and gas companies in general, and the retail was a mixed bag. It worked well until it almost didn't. But buying puts on the sectors that were failing, and companies were consistently reporting poor earnings, and buying calls on those ETFs on the sectors that were showing good growth and record earnings while the rest of us are paying a lot. Then just in the past few days, and didn't really warn you guys, but I should have warned you guys. We started to open new married puts, open a married put on Starbucks and another one that was actually at a reasonable profit. We looked at more strangles on SPY and QQQ, which those strangles worked out well with today's movement. Married puts, not so much. But again, I told you that I was looking to open new married put positions as you started to climb back up. Why the married puts is because honestly, and you hear me say this honestly, the only positions I'm really opening on stocks new are the married puts or standard collars where I have a floor that I can't risk more than 4, 4.5, or 5% on those positions. Even in a decline like today, I'm only down about 1% on that new Starbucks position, and it was down about 3.5, 3.8% at one point today. But I'm still comfortable with the position and the structure. We'll look at that later. Most important things, proper position sizing is key. Reduce exposure for the leveraged positions in your portfolio. Credit spreads, bull or bear. Debit spreads, bull or bear. Buying calls or buying puts, because the market is fluctuating and it's going up and down and it's uncertain. What do I mean by reduce exposure? Normally, you've heard me say that when I'm in a good market, I feel comfortable with the market. Maybe 15% or so of my total portfolio is allocated to bull put credit spreads, or bear call credit spreads, or bear put debit spreads. But in uncertain markets where we're seeing some of these swings, sure, we're seeing 20 to 30 days of a downturn and then move upwards that might last 2 to 3 weeks. That March run was pretty strong. But again, where I'd normally be in 15% allocation, scaled that back down to maybe half of that, 7.5%, 8% of the total portfolio, because I don't want to allow myself to see 70 to 80% losses with 30 to 40% of my portfolio. Hedge new positions in the form of collar or married puts, and riskier parts of the portfolio, such as those credit spreads, using those shares of the volatility ETFs, calls on the VIX, or even puts on SPY.